Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. I'm super excited for today's episode. Joining me, we have Nelson. Please go ahead and give yourself an introduction.
Well, thanks, first of all, Dave, for having me on the podcast. And that is a fantastic hat. Everyone should go and buy 7 of them. My sort of background is I was originally sort of was a real estate investor, and probably about 10 years ago or so, I really started getting serious about the stock market. And kind of as my journey sort of went on, I really embraced a dividend growth sort of approach, and I've been successful enough in that to officially retire from full-time work in 2022, the end of last year, and I've been financially independent, just kind of living off my dividends ever since.
Wow, that's awesome. So, yeah, definitely part of that FIRE community. Financial independence, retire early. You've definitely retired a lot earlier than the majority of people.
Yeah, and for me, when I first started to invest, it was very much I wanted to hit a certain kind of level. Like I wanted to be a millionaire was the
Right.
sort of when I first started investing. I was like, hey, that's what I want to do. And then kind of once you sort of hit that goal, you got to start to think, okay, like what am I doing all this for? Like it's okay to have some money in the bank, but it's what's the point of all this? And the FIRE movement really sums it up. It's freedom, and it's
Right.
having that ability to do kind of whatever you want whenever you want. And that was the motivation for me the last kind of few years for sure. And of course, as part of my evolution as an investor, I really when I first kind of started kind of like 8 to 10 years ago, and I really didn't have any desire to retire. I enjoyed what I did. I thought that work was this sort of noble thing that people should do, and my attitude has certainly changed over time on that.
Yeah, so I'm also interested you mentioned, beginning investing in real estate, so I'm guessing physical real estate is what you were, discussing. So, I guess how did that start and then the transition from physical real estate into the stock market? And do you still have physical real estate as part of your investment portfolio?
So I sold my physical real estate right around the same time as I retired. And it was just time to sell it. I'll get into that.
Sure.
Kind of tell everyone the whole story here my parents have owned real estate for pretty much 40 years now. My dad I always remember him working on these houses kind of after supper, doing all that stuff. And I was fortunate that right around the time when I was in high school, I got a job at Dairy Queen, and my dad actually broke his leg, and it's a real nasty break, and he was basically like at home for 6 months, couldn't do much of anything.
Right.
And I was fortunate that I was kind of starting to get interested in this stuff right at the same time that he had some time to teach me, and he taught me the basics of investing in real estate. Told me kind of how powerful passive income is, and how powerful that concept was, especially at that point in his life when he couldn't work, and it was kind of this rental income that was keeping our family afloat at the time. And I was fortunate enough to learn it from him at that time, and then I turned 18 and I started buying real estate in the small town that I grew up in. And the cap rates on this real estate was, like at the time, it was like I get a 20% return invested in real estate. Where like, I mean, now it's like 4% or 5% or whatever. You want to buy residential real estate pretty much anywhere in the country. But I didn't know how good I had it. So I just kind of I bought property, and then I bought another one, and then I bought another one. And then the town values really started to go up, and the cap rates kind of went from 20% down to like 10 to 12%. And I said, you know what? That's not really that exciting. I'd rather kind of put my money into other things. And so then we were involved in some private lending for a while. And then as interest rates started to go down, the premiums you could get on private loans weren't really that exciting. And then it got to the point where it's like, hey, I should diversify away from this small town, real estate in this small town, and the sort of comparable return expectations in the stock market were about the same as I could get on the private mortgage portfolio. So now I'm officially out of both private mortgages and real estate, just in the stock market.
Yeah, wow, awesome. Interesting background. Very lucky to have someone like your father who was able to teach you all the ins and outs at a very young age and really help set you on the right path.
Yeah, I was incredibly fortunate to sort of have that interest at the same time that he had the time to teach me. It really set me up really really well, especially just getting out of school when a lot of my peers did what young people usually do and sort of wasted a lot of their money, and I was fortunately smart enough to say, hey, I'm I want to get ahead. I want to do this. I want to do this. And yeah, like I said, just fortunate enough to figure it out at a young age.
Yeah, that's great. That's a great background. And so now completely into the stock market and obviously loving the passive income, loving those dividends rolling in every month and every quarter. Um, so I guess yeah, let's just kind of get into sort of what interests you in the market, like what sectors, what companies.
Well, when I first kind of really got interested in the market, I dabbled a little bit, kind of like shortly after 2008, 2009. I was really sort of like trying to figure out what worked and what I was interested in, and I first started with a kind of like a deep value sort of approach. So I was buying like coal companies and like power, like these crappy little power companies, like distressed preferred shares. Like it was really sort of I thought I was smarter than what I was, and you kind of like their value investing and kind of like that community is very much like it's like you can bend over and you can pick up a dollar, or you can go into this like super complex special situation and get $1.20, and they like think that there's some sort of I shouldn't say they think. My interpretation of what they think is that there's like bonus points for getting into stuff that's more complex, and I kind of fell into that for a little while. I had a concentrator portfolio, and it's with 5 names in it, and then kind of 2 of the names very quickly back to back just kind of blew up, and I said to myself, this isn't working. Like, I'm not diversified. I'm not acting like someone who has wealth to protect. I'm acting like someone who has just started out, who has like a, low 5-figure portfolio and who wants to like hit home runs. And so from there, it was kind of like, okay, well, I don't want to hit home runs. I want to protect my capital. I want income, because the goal was to eventually retire on my passive income sources. So what am I going to do? Okay, well then, working backwards from that goal, it was I'm interested in dividend payers. I'm interested in REITs. I'm interested in utilities. I'm interested in these boring stocks that just sort of can deliver predictable income, but also deliver capital gains, so I get solid long term returns.
Yeah, that's amazing. I definitely have a few points there, but before we get any further into it, you mentioned you wanted to buy 7 of these hats, which you can do at buyinvestingshirts.com. The link will be in the description below. You can get this one. The passive income posse merch is there: t-shirts, hoodies, coffee cups, and use code word posse for 5% discount on your purchase.
Why stop at 7? Buy 10.
Buy 10, even better. Buy 10. Give one to everyone you know.
Buy one for all your friends and all your enemies.
Right, exactly. Um, so yeah, okay, this is awesome because this is right up my alley of you mentioned REITs, you mentioned utilities, and just this boring style to investing. So first off, everybody that watches the Passive Income podcast on a regular basis or follows me on Twitter knows I absolutely love my REITs. I love the REITs because it gives you that exposure to real estate without being the landlord. You don't have to go out after supper to work on houses or really do anything, right? Um, and all of the REITs in Canada that I have are monthly dividend payers. And I get it that, 5% is 5%, whether it's paid monthly or quarterly, but
Mhm.
I don't know, it's just kind of that nice psychological boost to see it, appear in your account once every 30 days or so. So I guess let's hop into REITs first.
So what I love about REITs is all that passive stuff that you mentioned. And I was a landlord, and my dad helped me manage my properties. So I had a much easier journey than most landlords, and even like my like kind of real estate on easy mode. It was just stupid. Like the phone calls, and my tenants were good.
Right.
I posted a thing on Twitter, the one day where I said, I held real estate for 20 years, and I never once got a 2 a.m. phone call about bathroom troubles, because that's always that sort of
Yeah.
that stereotypical thing. And there's so many people who replied who said I have, and my tenants phone me once a month, like at 11 o'clock at night. It's like, well, one, your tenants suck, but two, it's like there is certainly that, you know, I'm sitting down for dinner and my tenant calls me, and I've seen it with my dad, number of times. It's not like excessive or anything, but it's certainly a number of times. And that passive part of it is just wonderful, where it's like, I can invest in these large REITs. I pay, like a fraction. I pay a very, very small management fee in exchange for very professional management who handle all this stuff for me. And then I do absolutely nothing.
Right.
The other thing that I really, really, really like about REITs is that there it's easier to find real estate deals if you're that kind of real estate investor who says I want to buy cheap. It's easier to do that in the public markets than it is in the like kind of the physical real estate market, because a lot of realtors, at least where I come from, they gobbled up these deals before they even hit the market. They would they would come into the office, kind of talk amongst themselves, and someone would buy it within 3-4 hours. The really good deals. Where in like the public markets, I can look at like an artist REIT, and it's a $7 stock right now. Management's net asset value is $18. That's probably inflated. So then I can look at the portfolio myself, and I can look at how much income they've made, and I can say, hey, I think maybe net asset value is $12 to $14. Well, if I'm buying that for $7, that's still a fantastic deal. Versus, I mean, in Toronto, yeah, they put them on the market for 50 or 60% off the true price all the time, and then they just get bid up to the actual price. So that's the thing that I really, really like about REITs. I can go in and I can say, hey, I'm buying this at a discount. I know I'm buying this at a discount. And yeah, sometimes it doesn't work, but if I've got the NAV value wrong, I've still got the dividend. I've still got the distribution.
Right. Yeah, and the barrier to entry is much lower too. Like you said, artist being a $7 stock, and if someone's just starting out, they can afford that $7 and just getting started. Whereas, they may not have 20 or 35 or $40,000 for a down payment.
Hmm.
And if they did at that point, maybe depending on wherever somebody is in their journey in life, if they had that, say $35,000, they want to put it down on a primary residence before getting into the physical real estate. So yeah, just the barrier to entry with REITs is obviously a lot lower. It does give you that exposure to the real estate, and like you said, there are several really good REITs in Canada that I invest in, and I'm guessing you do as well. I do definitely have to get your thoughts on RioCan.
Hmm. So I have my largest three repositions are Smart Centers, RioCan, and Choice Properties. So RioCan, of course, has the development portfolio, which has a certain amount of office space. The Well in Toronto is the prominent one, and of course that is the office space that Shopify was supposed to take, and then they've said, hey, we don't want office space anymore.
Right.
And they're still going to have to pay for it because they signed the contract, but they're looking to sort of sublease it to someone else. So when RioCan announced the development program in 2018, 2019, whenever they started doing it and they started building the well, of course nobody could see what would have happened with office. But RioCan has the solid retail portfolio. They like that part of the portfolio skated through COVID, no problem. It's every bit as strong as what it was in 2019. And there's just like this little bit of office space sort of coming in that's going to be on top of that. Of course, they've got some residential they're developing as well. So RioCan is a solid long term hold. I think it's about $22 a share. I'm not adding to it right now. Choice Properties is the one I'm adding to, which is of course, Loblaws anchored retail that also has a development program on it, but they're focused more on industrial and residential, which are two areas that are probably going to do better over time. In fact, Choice Properties last year sold their office towers to Allied in exchange for Allied stock. So you get a little bit of exposure to office in Choice Properties, but they kind of saw the writing on the wall and got out.
Yeah, and that office space is a tough one because like you said, no, in 2019, nobody saw what was coming in 2020, 2021, and all of a sudden everyone was working from home, or the majority of people were suddenly working from home, and now to this day, a lot of them still haven't gone back to the office because they've like, I can work from home. I don't need to drive. I don't need to fight through traffic. I can just do it from here, right? So
Well, that's it. People, there's a lot of people who got a taste of working from home and said, "This is fantastic. I never want to go back to the office." And that's a problem for office space going forward. Now, is it a problem that a recession sort of helps clear up? Potentially. I think it's a lot easier if you're one of the big five banks, whoever who's got just tons and tons of people still working from home. You say, hey, listen, like times are tough right now. If you don't come back to the office, we're laying people off next week, and one of them might be you. And that cures, I think, a lot of kind of this problem, if you will.
right.
Uh, Now, I mean, this is tough because so I have a little bit of Dream Office REIT, and Artis has some office space as well, and so it's like I like office as like I'm buying at kind of 30 or 40% of NAV, and the market is just kind of giving it up for dead, and it's cheap, and I like that I get paid while I wait. And it's a very kind of small risk in my portfolio. But office is a problem, and I could be wrong on office, and that's why it's a much smaller part of my portfolio versus Smart Centers, RioCan, Choice Properties.
Yeah, great answers. I've recently been hammered with TNT. You're probably familiar with TNT. I thought I was really smart when I was buying it because I'm like, again, pre-COVID, and you're like, this is office space that they lease primarily to the governments, like the
Government
federal
space,
and,
yeah.
and provincial governments, and you're like, well, the government's going to pay their rent, pay their lease, so right. But I'm guessing a lot of those government workers are now working from home, and that TNT REIT has really been hammered recently, and they did. Again, I feel like I suffer a lot. I feel like I suffer as many dividend cuts as I do dividend raises, which is like hopefully over time, and I'm sure over time the raises will outperform the cuts. But
One of the things for me that I was lucky enough that I just happened to run into a guy who this is in the pandemic during 2020. His wife was in government real estate, and he was saying he's like there's a lot of internal talk inside various levels of government saying we have too much real estate and we need to, and he's like the average person would just kind of like shudder at how much real estate various levels of government rent and how much kind of wasted space they have.
right.
And if it's a future where a certain percentage of government workers work from home, then that's really bearish on a lot of office space, and especially kind of like, Class B, Class C, um, like office towers in Winnipeg. I'm definitely less bullish on than office towers in Toronto. I think I'm getting
Yeah.
a really, really good deal on the office towers in Winnipeg, and then a really good deal on the office towers in Toronto. So I'm willing to kind of like plug my nose and make it a 0.5% position in my portfolio. Um, but I certainly envision a world where office space is permanently impaired, or they have to do stuff like try to change it over to residential, which is just a mess. As anyone who has tried something like that knows, it's a lot of times just easier to just tear it down and start over.
Right. Yeah. Several several things to unpack there in that statement. A lot of the one thing I'm thinking is like, okay, that's that's taxpayer dollars, all those government rentals and leases, and you're like, oh, you know, from the taxpayer side of it, you're like, okay, maybe we don't want it, the government's leasing all of that property because literally we could just save millions and billions on taxes, or those tax dollars could go somewhere else more useful.
Hmm. Yeah, but at the same time, the argument is there's a lot of people who have said during the pandemic that, in fact, I think one of the things a lot of people like about working from home is that they don't have to be as productive because they're not as closely monitored. And I mean, we've all heard the stories about mouse jigglers and guys just working two jobs and because they have 20 hours a week for each, 20 hours of work per week for each, and they're just kind of sort of taking advantage of the situation. And if that's the case, if that's actually happening, then it's a very compelling argument to say no, we got to get people back to the office, or
Right.
else there's this permanent kind of impairment to productivity, which is very bad for an overall economy. So this is all nuanced. Like, who knows? That's the fun of all this, right? Is to kind of look at it and make your own bet and see what happens.
And I did see here on, if I can just find it quickly, on
Hmm.
your Uproar Capital on sub Substack.
Substack.
Sorry.
So sorry, I was just gonna say Substack is kind of the platform for newsletter writers now. So that's where people can find me. Uproar Capital at .substack.com, or just Google Uproar Capital. You'll find me.
Right, and I will put the link in the description below. I was scrolling through here earlier, and I did see the article that you wrote, or the blog that you wrote on Canadian Tire REIT.
Hmm.
So there it is there. Canadian
Yep.
Tire REIT, quality at a reasonable price. Let's talk about Canadian Tire.
Well, so I disclosure, of course, is that I own Canadian Tire and Canadian Tire REIT. Canadian Tire is, of course, an iconic Canadian retailer. I don't normally like retail. I think it's kind of a crummy business um, overall, but I really like Canadian Tire has a moat. It's very obvious Canadian Tire has a moat. I mean, when you're looking for household stuff, like where do you go? You're looking for that thing to recharge your air conditioning in your car, which I had to do on my old car. Like I went to Canadian Tire and I bought the part, and
Yeah.
so Canadian Tire, iconic retailer, good financial services arm attached to it. You'll hear kind of U.S. guys come in and say the financial services arm of Canadian Tire is terrible. All the people are going to stop paying their bills once the recession hits, and it's just not really gonna happen. Um, it's yeah, they're credit card lenders. They have sort of a little bit more of a subprime kind of clientele, but it all works in terms of getting people to the store, getting people involved in their loyalty program. And I mean, I bought it at about 150 Canadian Tire, which was like 8 times earnings or 9 times earnings or something, which is just a huge, I think, a huge margin of safety. As for Canadian Tire REIT, of course, I think like about 90% of their revenue comes from Canadian Tire. And it's indirectly a bet on Canadian Tire, because if Canadian Tire starts, like, all these stores start failing, then they end up with all this real estate, and how do you sort of repurpose that? Well, you can, but it's a struggle. But it's just they they own the real estate for Canadian Tire brands, so that includes Marks, Sport Check. They'll build these kind of ancillary um, kind of facilities for, they'll take a Canadian Tire, and I'm thinking of the small town I grew up in, which where I'm visiting this weekend. I'm doing this in the hotel room. There's a Canadian Tire, and then right next to it, a couple years ago, they built a Marks,
Right.
um, and so it's just these really easy incremental development opportunities that they know are going to work, that can just slowly add to the bottom line over time. And that's exactly what they've delivered since, I think, 2013 or 2014 IPO. And it's just kind of consistent, 2 to 3% um, earnings growth per share, just kind of just consistently up. And then the dividend is, or the distribution has kind of gone up consistently as well. So it's just a really, really solid performer that might be a little bit expensive on a valuation side, but you tend to have to pay up for that kind of performance.
Yeah, great thoughts, and definitely Canadian Tire is an iconic Canadian retailer. I've used the example before. Any kid who has played hockey in Canada has got some piece of equipment from Canadian Tire, whether it's a stick or gloves or skates or helmet or shin pads, you name it. Every kid has got at least one piece of equipment from Canadian Tire.
Yeah,
So
no, and I mean, like I said, the car stuff,
yeah,
Marks, Sport Check, like these are good brands that just consistently, like sports equipment in Canada. Like you said, where are you going to go? Well, you go to Canadian Tire or you go to Sport Check, and other than that, like they, and they're just they're smart operators, and I'm happy to have bought it at such a nice valuation.
right. Let's jump to another sector. I didn't realize we are going to end up talking so long about REITs and and everything, but yeah, as everyone knows, I love the REITs. So we could talk. We could do an entire 2-hour podcast just on REITs, probably. But
I love the REITs too. So yeah, they're great. And I just one final thought on REITs. A lot of them don't have that dividend growth that people want. But I mean, if you're getting a 6% yield on a REIT versus a 3% yield on something else, you can create your own dividend growth by taking that REIT distribution and reinvesting it into more REIT, like the same REIT shares,
yeah,
which REITs still often give a discount for people who drip. A lot of the kind of more traditional names don't give a discount anymore. It's just like, hey, if you want to drip, knock yourself out, we're not giving you a discount. A lot of the REITs do, and so that really, really helps. But if you just drip it, even if you don't get the discount, you have a 6% yield. You add 6% to that every year. You're giving yourself a 6% raise
right.
every year. Just drip. That's one way to easily do it.
Yeah, I think that's a great point. Like I said, let's jump to another sector. You did mention briefly Canadian banks, so obviously we know the banking sector in Canada has historically always been very strong with the big five, including National Bank, the big six. So yeah, just any thoughts on any of the banks?
I have all six of those banks that the big six in my portfolio. I also have a little bit of a Equitable Bank. It's a smaller position because it is riskier because of the Equitable is a little bit more of a subprime lender, and they're not really subprime, but they're more subprime compared to the big six.
Right.
So I've got those seven in my portfolio, but it's you know the big six are probably about 15% of my portfolio. They combine to be just to give the listeners here a little bit of background is that I'm widely diversified. I probably have 60 or 70 different names in my portfolio because I want to avoid that blow up risk that I experienced in 2013. So it's a big position for me, the banks. I looked at banking in Canada and I said, okay, you've got a main business of lending people money to buy houses. And of course there's other things. There's wealth management, there's credit card lending, there's all, like, some of them are insurance, but mostly it's just lending people money on mortgages. And then you've gone to the federal government, the best counterparty ever, and you've said, insure the worst mortgages. Make sure that if this risky mortgage goes south, we still break even. And the federal government said, done.
Right.
And like, it's great. Like, what a, the non-risky mortgages, like just don't go south. You know, if I go to Royal Bank and I've 50% equity and I want a 50% mortgage, chances are Royal Bank is going to be able to sell that house and get their money back if I don't pay. But if I have 5% down and I go to Royal Bank and I say, hey, I want a mortgage, they need that protection. And then they got that protection and then I pay for it. Royal Bank doesn't pay for it, I pay for it.
Right.
It's a great business. It grows as fast as the Canadian economy grows over time. So I'm happy to own it, hold it, stick it away for a long time. And periodically, when things happen, like in March, when they had that little banking crisis in the US, add a little bit more to my portfolio. They're about equally weighted in my portfolio, which means that from a dividend income perspective, I get more dividends from Scotiabank and CIBC just because they have higher dividends than the others, and they trade at a persistently lower valuation as
Right.
well.
Wow, interesting. Great points there about the sort of the insurance and the federal government backing, basically backing the banks, right? And it's so yeah, much less risky than what we have seen. Well, like you said, recently in the U.S., but even going back to the 2008 2009 crisis, where well we saw what happened in the U.S. there, and
Hmm.
kind of same thing. The Canadian banks, their prices went down, but they were still like I'm their stock prices went down, but they were still very solid investments at the time, right?
Yeah, and I mean that's been one of the bear arguments on Canadian banks for a while is that you know Canada's housing is in a bubble. Canada's housing is not in a bubble, and I will die on this hill. Toronto and Vancouver, like maybe in a bubble, potentially in a bubble. I'll give you that one.
Yeah,
Like they're expensive, and if I lived in Toronto, I would.
move.
It's hard. Well, like because it's like I think that Toronto real estate over time does just fine. Um, it's a supply and demand thing. There's lots of demand. There's no new supply. That translates to higher prices over time. I would probably move. You're right. But you look at like I don't know where you're from, Dave, but I live in Edmonton, and you can buy a decent condo in Edmonton, in a newer, yeah, not a brand new building or anything, but $200,000 gets you a pretty decent condo in Edmonton. $400,000 gets you a detached house with a garage and a yard in a newer neighborhood. $500,000 gets you something pretty nice, and then anything above that is just like, wow, that's big, that's nice.
Yeah,
Um, Edmonton's affordable. You know, all these other cities are very affordable. Toronto and Vancouver aren't.
yeah, exactly. No, I'm about 2 hours east of Toronto, down the 401. So um, similar, it's a small city here, 50,000 people or so, and within the city, some of the housing prices are a little higher probably than they should be. Um, and part of that actually is what happened a couple of years ago when people started selling their, you know, 800,000, 1.2 million places in Toronto. Well, they
Right.
started kind of pushing this way, which pushed the prices up here a little bit, but still fairly reasonable. Very comparable. Like my house was, I think, 409, 410, and very similar to what you described, detached house, garage, yard. So and I'm not right in the city either. I'm in more of a rural area, but not too far away from town. So
Mhm. That's it. And that's always going to be my advice to people who, cost too much in Vancouver, cost too much in Toronto. Hey, it sucks. You shouldn't have to move, but you might have to move.
right,
Especially if what I've never got is okay, you're in Toronto, you're working finance. Um, you've got this potential to earn like a lot of money, which okay, great. I understand why you're going to be in Toronto. Like you have to be in Toronto. But if you're a social worker or a teacher or a nurse or a whatever government employee, like there's so many jobs where it's like it doesn't matter where in the province you go, you're making about the same amount of money. Well, why would you live in the most expensive place when you can go to another province, do a comparable job? And Alberta's, always my example because, teachers in Alberta make about 20 or 30% more than teachers in Ontario. There's more jobs available in Alberta for them. And they can buy a house for half the price,
The
maybe a
cost
third
of
of the
living
price.
is way lower.
And it's just it's so much easier to get ahead in Alberta. Um, and if you don't want to be a teacher, you can get a fancy oil job, but
Yeah.
those have other issues. There's a weird culture around that. That's all I'll say.
Well, let's dive into the oil and gas sector and energy utilities. Sort of anything. I know those are kind of different but similar sectors. We all need energy, whether it comes from oil and gas or that energy is coming from hydroelectric or anything. Like, yeah,
Yeah.
just jump into your thoughts on that whole realm.
Sure. So I'll start with oil. I have three oil stocks in my portfolio. If you don't count the pipelines, which I don't, I think their pipelines are much more utilities than energy. So I have Canadian Natural Resources is my largest position, and then Imperial Oil and Suncor. And one of the things that I do when I look at a stock now is I do like a quality sort of check in my head, and it's like I want sort of the best quality stuff in every sector. And I looked at oil and I said, okay, what's the best quality oil stuff? And it's like, well, what do I want to make sure that there's not a whole lot of exploration risk, which is, um, you have to replace reserves, and sometimes the reserves that get replaced are very good reserves, and they get replaced with like poor reserves. So I wanted to like avoid that risk. And then I wanted like good solid balance sheets, and I wanted a history of kind of superior capital allocation. And it just really led me to the oil sands stocks, because the oil sands, it's like, okay, they're big investments kind of made once that pay off for decades afterwards. As they go, and it's essentially mining operations. It's different than conventional oil, and so I like that because the economics are a little bit more dependable than a conventional exploration and production company. The other thing I like about these guys is that Suncor and Imperial Oil have these refinery assets, and those kind of just consistently churn out profits, no matter what the price of oil does. And for Imperial Oil, especially, essentially their profits from the refining and marketing division pay for the dividend. So I don't have to worry about the dividend. I just have to like I get the upside when oil goes up, but I don't have to worry about the dividend on the downside if oil goes down, because I can't predict the price of oil.
Right, right. Yeah, exactly. I do also have some Suncor in my portfolio. So, yeah, I really like that company as well.
Yeah.
Um, Kind of getting more into the utility side. And I did notice it looked like you had an article there on your blog, Algonquin Power.
So Algonquin Power is fascinating, because it's this inadvertent look into investor psychology. And so I owned a little bit of it. And it was mostly based on like the reputation that it had, because it had just a stellar reputation, dividend growth, acquiring new utilities. They're into gas, they're into water. It was this diversified utilities company. Everyone loved Algonquin. You're nodding, you know what I mean.
Yeah, well, I
And
still love it, to be honest.
so they ran into some issues, and the balance sheet was a little bit stretched, and then they were kind of stupid, and they left a lot of the debt floating rate debt. So, 30% floating rate debt was what I figured out when I looked into it, and that's a lot, especially when interest rates are going up. And then they had some issues with, the it didn't wind didn't blow as much as expected, and that kind of um, led to some really crummy results. And so then, of course, the dividend's going to get cut. Everyone knows the dividend is going to get cut.
We all saw the writing in the wall back in late November, December, and then when it happened in January, it was actually kind of a nice relief. It's like, okay, just rip the Band-Aid off. We knew it was coming, and just please do it, right?
Yeah, and the psychology part that I was talking about, where it's like, what happened when they cut the dividend? And I mean, I took a fresh look at it, and I wrote about it there, and it was like I saw a utility that was trading at about 10 times earnings, and a regulated utility that owns, like, yeah, they have the power plants that they own, which is an okay business. And then they have all the, water lines that they own, the gas lines, and the power lines, all these utilities they bought. And that's like a Fortis business. And Fortis traditionally trades at anywhere between kind of like 17 to 22 times earnings. And it's like, okay, if I assigned, like, say, a 15 multiple to Algonquin over time, even though it had traded at like a 20 or 25 multiple before, and I'm buying it at a 10 multiple, well, that's a 50% upside. And the dividend's going to get cut. And I know the dividend's going to get cut, but it was a 10% yield. Okay, if that gets cut like by 60%, what's still 4% yield? And the payout ratio was too high. It was like 110, 120%. But you cut the dividend in half, and all of a sudden it's like that's a 60% payout ratio. And that gives them room to grow over time. So I really liked it at $10. The other thing that I'll say is that AltaGas, the exact same thing happened to them in about 2018. They made an acquisition, they had too much debt, the market hated all the debt, and the stock got crushed. And then right before it cut the dividend, I looked at it and it traded about 5 times earnings. And I said, this is a company with a regulated utility business and an oil, natural gas pipeline business. And I think the regulated business is worth a lot more than what the market is valuing it. I'm in. And Algonquin just told me that exact same thing. So I bought a bunch at, it was around $10 a share. And it's worked out quite well for me, but I'm going to hold it for a while. I think that if you looked at Algonquin today, without the history of the dividend cut, you would say this is a good company with some temporary issues, trading at about 12 or 13 times earnings, which is still very, very reasonable.
Yeah, I did not buy more after the cut, and I'm kind of kicking myself because yeah, at that $10 mark, I really felt like, I even tweeted it one night saying, "Is now the time to be greedy while others are fearful on AQN?" And well, I mean, the types of responses you get on Twitter to a question like that. So the responses were all over the place.
The I posted a kind of a guide to criticism on Twitter that I really enjoy, where it's basically like, if it's someone who you follow and who interacts with you and who kind of understands who you are, then and they criticize what you're thinking, then it's something you should take seriously. If it's some guy with a like no profile picture and 27 followers, like, he can be safely ignored forever.
Right.
And I've gotten a little bigger on Twitter, and the bigger I get, the more I realize that that rule, you need that, and it
It
doesn't really,
applies.
yeah, it doesn't matter if you're 500 followers or a million followers. It's just ignore the people who show up and have no idea what you're doing, who just want to criticize.
Right, right. I do want to talk about the telecoms in Canada, Bell, Telus, Rogers, and now obviously after that Rogers and Shaw deal, Quebecer slash Videotron is going to become a bigger player in the cell phone market as well. So yeah, just thoughts on any or all of those companies and that deal as well.
So I recently started a position in Quebecor. Part of the proceeds from my rental houses that I sold got put into Quebecor. I like so their whole kind of strategy in Quebec. People from Quebec listening know this, is that they're the kind of low cost operator. And what they've done is they've sort of like brought prices in that whole province down as, Bell and Telus try to compete with them there. And I think, it's going to be a lot harder to take the wind assets from Shaw and kind of do that for the rest of the country, kind of bring these rates down. But Quebecor has a demonstrated history of building a low cost carrier and growing it to a critical mass. And I think that they were the only logical buyer for these assets, and that they will eventually do a good job for them on them. And you're getting that it trades at about 12 times trailing free cash flow. And of course, telecoms are tricky on a free cash flow basis because they're reinvesting so much money into growth, and so they're trickier to value. you have to really look hard at the capex if you want an accurate picture. But it's cheap, and I like that acquisition. As for I own TELUS. TELUS is a top 10 position. It might even be a top 5 position for me. They've delivered excellent growth and solid management. Bell's also a relatively big position for me. I own a little bit of Rogers. Um, it's of course they have a lot of debt now with the Shaw deal, and they've sort of doubled down in cable in Western Canada, which I've kept an eye on Shaw. I used to own Shaw, and I sold it because the cable division is really a melting ice cube. TELUS has taken share from Shaw in cable in the West, so I don't necessarily love the Shaw deal for Rogers, and I still own a little bit of Rogers. I might sell because I don't. I try to be patient and not sell until the thesis changes. And now with Rogers, the thesis has kind of changed, where it's a payoff debt story, and it's kind of a levered growth, more on cable, more on kind of content than telecom, where Quebecor is getting more into telecom, which is the direction that I like. I think that telecom is a better business than cable.
Yeah, okay, understandable. I'm kind of thinking, like you called cable a melting ice cube. I think cable and satellite could have a bit of a resurgence simply because, like, 10 years, 15 years ago now, Netflix came and really took a bite out of that, cable and satellite. Like all these movies you can get for $6 a month. But now it's like if you had every streaming service and you're paying 15 or $20 a month, like suddenly you're paying like twice as much as what you would be paying for cable or satellite. So now the argument is, well, I could get cable or satellite for whatever, $80 a month and not pay these, say, 12 different streaming services, or all, even if I like $10 a month, that's $120, right? So I see a little bit of a resurgence in cable. I could be wrong. I don't know. I'll be the first to admit if I am wrong. People don't. Hey, I don't get everything right all the time. That's for sure. Um,
No, none of us do, right?
right. So yeah, that's just sort of my thoughts on cable and satellite. And obviously, yeah, Rogers is betting on the cable division because that's what Shaw is obviously big for. And then obviously, Bell has, the Bell Express View satellite division. So
Mhm.
I- who knows? Who knows where it's
Yeah.
going?
I'll say that part of the reason why Shaw was melting was because they had that strong competition in the West, and TELUS was taking share. TELUS was growing their cable satellite business as Shaw was losing share. So you're right. It was just Shaw was kind of the weakest operator in that market. The other thing is that of course Cogeco is a pure cable operator, trades at I think about 7 times earnings or 6 times earnings. And of course, their strategy is more rolling up these kind of small regional cable operators in the US, um, using debt to do so, paying down the debt with their massive amounts of cash flow, and then kind of doing that over and over again. And I've got a little bit of Cogeco because it was just so damn cheap. Um, and of course, it's Cogeco's got I think got about a 4.5, 5% yield, and it's growing at 6 to 7% a year, and they've guided kind of to expect that sort of growth going forward. So I'm not super bearish on cable. I'm a little bit kind of bearish on Rogers. I say,
Yeah, fair
um,
enough. Fair enough.
yeah. And so just one more thing is an investment in telco is a investment in cable. It's not maybe a direct investment in cable, but they've all got cable divisions. You're
Right.
making a bet on cable, and when the customers renew, it's a 50% operating margin business, which is pretty good.
Yeah, yeah, I'm beginning to refer to the sector as like telecom slash media. Obviously
Mhm.
Bell also owns like TSN and like a ton of different the actual television stations as well. So yeah,
And I was going to say they have the sports teams too. So Rogers has the Blue Jays,
right.
and both Bell and Rogers own big chunks of Maple Leaf Sports Entertainment, which sports franchises just keep going up. I don't know if you saw the Redskins, sorry, not the Redskins, the Commanders, um, sold for what, $6 billion or something. Like these valuations for sports teams are insane.
Right.
But hey, Rogers and Bell have the sports team, so that's good.
Yeah. Yeah. So, and again, that's sort of, the entertainment. So, telecom, media, entertainment, like it's becoming a much bigger package than what just, Bell was way back in the day, 40, 50 years ago, and it was literally just landlines, right?
Yeah, right. Yeah, for sure. And TELUS, of course, doesn't really have a lot of that. And a lot of people prefer that for TELUS is they don't want that exposure. And if you don't want that exposure, then great, just buy TELUS. You get a little bit because they do have the cable division, but they don't own any networks. They don't own any sports teams. They've diversified into things like home security and they bought the I can't remember the name of it, but all the cell phone repair shop chain, mobile repair. I can't remember what it's called, but they've
Yeah.
diversified into stuff like that.
Interesting. Well, another acquisition merger that I want to discuss is Canadian Pacific and Kansas City Southern, the railways, and I guess get your thoughts on that merger slash acquisition as well as CN as well. Obviously, we're going to be talking about the two main, well, really the only two rails in Canada.
So those are I won't say a lot on them because I haven't. Those are just two stocks that I purchased for my parents' account. I plan to inherit that money someday, so I sort of view it all as one kind of giant account. And I just said I'm buying these and I'm tucking them away, and I'm just never paying attention to the rail business again because it's just such a solid um, kind of long-term bet on transporting goods, and it's just a much better way than trucks, which have all these environmental issues. And so there's a lot of, I'm not going to say noise around but like there's consolidation. And when they do consolidation and they're like, there's a deal and it's a certain amount of stock and a certain amount of cash and those kind of things make my brain hurt. And it's just kind of one of those things that I've kind of punted it back to the management of these guys and just said, hey, you guys be in charge of capital allocation for me in the rail business, and I'll just kind of quietly collect my dividends. So I don't have much to say on that because I'm not really that well informed.
Okay, fair enough. Fair enough. I did notice another. I think it's maybe your most recent article on your blog post, Metro grocery store, and yeah, let's dive into sort of the consumer staples sector.
So, like I said earlier, I think retail overall is you have to be really careful going into retail. It's not a business with great economics, and my career before I retired was in retail. I know how hard it is. I know how you're everyone's trying to sell the same box of Cheerios, and what's a consumer going to do? What do you do as a consumer? You go buy the cheapest one you can, and that makes it you know, difficult for retailers to compete with each other because it ends up being a race to the bottom. What I like about Metro, so the article was kind of about in the 1980s, Metro went on this diversification plan, like a lot of companies were in the 1980s, and it was a disaster. Except they got they paid the equivalent of $4 million for 20% of Couche-Tard, and that investment ended up being worth like $2 billion. If they would have never sold, it would be worth like $6 billion. I can't remember what the numbers are. Just these massive numbers on a $4 million kind of base. And it was the lesson was is that you can do a lot of things wrong as long as you do one thing very right. And that was one thing Metro did very right was that they got Couche-Tard and they held it forever, and then it went up and up and up and up and up, and then when it was a 150 bagger or something, they started to sell. So Metro, I do own a little bit of Metro. I it's a consistent kind of grower that has good capital allocation because they really don't try to own a lot of real estate. They lease as much of it as they can, and therefore you're not tying up huge amounts of capital into the real estate arm of the business, and that's why Loblaws and Empire Sobeys has spun off their real estate divisions, why Canadian Tire spun off their real estate division, is because they don't want to have all this capital tied up in real estate. It's kind of, you know, a distraction to the main business. So I do own some Metro. Capital allocation's been good, and the long-term returns for Metro have been excellent. And not just because of the Couche-Tard acquisition, although that helped. Dollarama is probably my favorite Canadian retailer. Dollarama has all sorts of success raising prices. It's kind of like a punchline where it's like, you know, it's like, this cost me $5 at Dollarama. Ha ha ha. Yeah, well, you bought it, didn't you? And so Dollarama is excellent. If you look at the American dollar stores, and I did the math. This is a while ago, so the math might not be as up to date. But it's like, if Canadian dollar stores have as much, you know, if there's as many of them per capita as there is in the U.S., there's potential for something like 10 or 12,000 dollar stores in Canada, and Dollarama's got 1,500 right now. So there's a huge kind of, if they can get that same concentration as the U.S. dollar stores, then there's the market for Dollarama to open up new stores is still huge. And Dollarama has success going into communities of, you know, 10,000 people, 5,000 people, but the U.S. dollar stores have had a lot of success going into communities of like 1,000 people or 2,000 people, where there's like a little grocery store in town, and kind of, you know, that's it. And going into these stores and we're sort of going into these towns and having a lot of success. And Dollarama hasn't really even tried that yet. And I think that they can, and they can sort of gain some further market share there. So and of course, Dollarama has expanded into Latin America as well. They've got 300 stores or something down there. So it's just a really good secular growth story for Dollarama. But it's 27 times, 28 times earnings. So the price is expensive. The other retailer that I own via accounts I manage for my parents is Costco. And how do you bet against Costco? They're such a behemoth. And if it got to the point where it was like kind of, you know, 20, 22 times earnings, I would back up the truck on Costco.
Right. You mentioned race to the bottom. You know, obviously, yes, consumers do want to pay the least amount for that box of Cheerios or whatever else they're buying at the grocery store. Um, but this is where I got really confused a couple weeks ago when, you know, Loblaws, Empire, Metro released like record-breaking profits to the point where they were even called into Parliament to try to explain, hey, you know, we're facing mass inflation. Everybody is like struggling to make ends meet, and here you guys are like, I guess basically the question in Parliament was, are you price gouging, right? And when you
Yeah.
when you unwrap it, that's basically the question they were trying to ask in more political terms. But so I guess just your thoughts on that whole scenario.
Yeah. So, you know, it's every now and again the grocers kind of stumble upon a scenario where they have pricing power. And 2020 to 2022 was one of those scenarios where it was like, you know, like you went shopping as this diversion to get out of the house. And of course, then the economy has been very, very good since 2020. So they've had success passing through these price increases, and it's gone very well for them of late. That's a hard thing to do when the economy is tepid or there's a recession. Now, of course, you know, people like the grocery stocks when there's a recession because you got to eat and you got to, you know, do all that stuff. But when there's kind of fewer dollars chasing the same products in grocery, the very quick thing to do is to just cut prices and to have more aggressive sales. So long term, I think that the economics of grocery are not as good as, say, like the economics of telecom or the economics of pipelines or the economics of a regulated utility. But I have some of my portfolio. It's just kind of a smaller, because you can still, you know, if you buy the best of a sort of a lackluster industry, you can still do pretty good.
Right.
It's superior management will kind of come through in the end, and that's why like Costco is such a beast, because it's they took something and they don't compete as directly as what like a Sobeys or a Loblaws kind of compete with each other. But at the same time, if someone bought Loblaws and Metro and stuck it in their portfolio, they probably do, okay, at
Right.
least okay.
Yeah, at least okay.
Yeah,
And yeah,
you know,
I definitely agree with the grocery stores being recession proof because your stomach doesn't care if it's a recession, if it's a bull market, a bear market. Your stomach just wants to get fed every day. So
yeah, exactly. The thing that I've noticed in my career in retail is that you're right, you got to eat, but what happens is you go from the more say like higher end products or to store brand and to lower end
yeah,
products, and that's okay for the retailers because they margins are generally better on store brand. But if you make a 30% margin on a $1 box of Kraft Dinner, or $30 or 30% margin on a $3 box of Annie's natural shells, there's more cash flow on the higher priced item,
right.
but they still get the sales, so that does make it recession resistant.
Wow. Well, I see we're already over an hour. I feel like we could talk for all day.
That's because
But
I
I
talk too much, Dave.
no, it's fine. It's great. Actually, I've really enjoyed our conversation, and I want to thank you so much for coming on the Passive Income Podcast. Absolutely incredible conversation that we've had. And just before we sign off, anything you'd like to say?
First of all, thank you for having me on the podcast. It's just something I've recently started to do is to try to get opportunities like this. And of course, for the record, for Dave reached out to me. It wasn't like I was, so I appreciate the opportunity, and I really enjoyed it. And yeah, it's just like you said, it's you can talk stocks,
All
and
day.
how much fun is that, right?
Yeah, right. Awesome. So, again, thank you so much for your time. If you're still here over an hour later, you know the rules. You have to hit the subscribe button now. I don't make the rules. Those are just the rules.
Those are the rules. Do it, everyone.
Subscribe.